Ladies and gentlemen, if you think gold is the king of hard assets, you're mistaken. There's another metal not as glamorous, not as talked about, and certainly not as widely held, yet it has the potential to make a new historical run that could dwarf what we've seen in decades. That metal is silver. Listen to me carefully. Silver is not just an investor's refuge. It is the greatly undervalued asset of our time. Too many investors sleep on it. They underestimate it. They treat it like a secondary asset. But every great investment cycle, every generational shift in price has one thing in common. It surprises the masses, but not the informed. Silver has spent years sitting in the shadow of other assets, quietly building pressure, while most investors chase whatever is loud and fashionable. When you look beneath the surface, what you see is not weakness, but compression. Markets move in cycles, and before every major expansion phase, price action tightens, volatility contracts, and sentiment fades. That's exactly where silver has been living. While headlines move from stocks to crypto to real estate and back again, silver has remained structurally undervalued relative to its historical behavior, its monetary role, and its industrial importance. This is the type of environment where informed investors start paying attention long before the crowd realizes something meaningful is happening. If you study long-term charts, silver has a habit of lagging first and leading later. It rarely explodes out of nowhere. Instead, it grinds sideways, frustrates participants, shakes out weak hands, and then when positioning becomes light and expectations drop, the real move begins. From a technical perspective, silver's multi-year structure has been one of accumulation, not distribution. Price has repeatedly respected major support zones. Momentum has refused to collapse, and each sell has been met with quieter, less aggressive downside pressure. That tells you something important. Sellers are running out of fuel while buyers are becoming more patient and strategic. At the same time, silver is not just a shiny metal sitting in vaults. It's an industrial necessity. It's embedded in electronics, solar panels, medical equipment, electric vehicles, data centers, and modern infrastructure. As global technology expands, silver demand expands with it. Unlike paper assets, silver can't be created with a keystroke. It has to be mined, refined, transported, and processed. That takes time, capital, and stable political environments, all things becoming less predictable around the world. When demand rises faster than supply can respond, price doesn't drift higher, it revalues higher. What makes silver especially interesting is its dual personality. It behaves as both a monetary metal and industrial commodity. When inflation expectations rise, silver attracts capital and courage. When economic activity expands, silver gets consumed. When currencies weaken, silver gains relevance as a store of value. That combination creates powerful asymmetry. Few assets benefit from multiple macro forces at once, but silver does. It doesn't need just one narrative to work. It has several, all pointing in the same general direction over time. Another important factor is relative valuation. Historically, silver tends to outperform gold during strong precious metal cycles. Yet, for long stretches, silver underperforms first. That underperformance builds leverage into the system. When capital finally rotates, silver doesn't move politely, it accelerates. You often see percentage moves that surprise even experienced investors. This is why seasoned traders watch silver quietly while others ignore it. They're not waiting for excitement, they're waiting for alignment, price structure, momentum behavior, volume characteristics, and macro stress to start pointing the same way. From a market psychology standpoint, silver is currently disliked enough to be interesting. There's no widespread euphoria, no extreme optimism, no overcrowded positioning. Instead, it's boredom, skepticism, and distraction. Those are the emotional conditions that tend to exist before a real trend begins. When everyone already believes something will rise, most of the buying has already happened. When people stop talking about an asset, that's usually when opportunity starts forming. Technically, the longer price compresses, the larger the eventual expansion. Think of it like a spring being coiled tighter and tighter. Each failed breakdown builds structural strength. Each recovery from support confirms participation underneath the market. When silver eventually clears major resistance zones with momentum, it won't be a casual breakout. It will be a repricing event driven by positioning, capital rotation, and structural scarcity. This is why silver's current undervaluation is not just about price. It's about time. Time is what builds opportunity. Time is what resets sentiment. Time is what allows smart capital to accumulate quietly without chasing. While many investors focus only on what's moving today, disciplined market participants focus on what's preparing to move tomorrow. Silver fits that profile exceptionally well right now. The market doesn't reward impatience, and it doesn't reward emotional decisions. It rewards those who understand structure, cycles, and behavior. Silver has been forming its foundation while attention stays elsewhere. When attention finally returns, price will already be far from where most people expect it to be. That's how major trends work. They start quietly, build slowly, and then accelerate faster than people believe possible. Silver's undervaluation is not a weakness, it's a setup. Markets never move in isolation. Every major price expansion is born from a combination of technical structure, capital rotation, and macro pressure building at the same time. When you analyze silver through that lens, what stands out is how many forces are quietly aligning beneath the surface. While investors focus on what is already trending, silver is positioning itself where trends are usually born in compression, skepticism, and structural stability. These are the conditions that precede revaluation, not continuation of old behavior. One of the most powerful drivers right now is the macro environment itself. We are in a world where debt levels continue rising, currency systems are stretched, and policy decisions attempt to stabilize short-term outcomes at the cost of long-term balance. Whenever purchasing power becomes uncertain, capital starts looking for assets that cannot be diluted easily. Silver fits into that category naturally. It isn't dependent on earnings forecasts or political promises. Its value comes from scarcity, utility, and history. When macro pressure builds, silver doesn't react immediately, absorbs it, and then releases that pressure into price when participation increases. At the same time, industrial demand for silver continues to evolve. Modern economies consume silver in ways that didn't exist decades ago. Energy transition, electrification, automation, and digital infrastructure all require silver's conductivity and reliability. Each new technology layer adds another reason for silver to be used, not just held. That consumption component tightens availability over time. Investors often underestimate how powerful this is. A metal that is both invested in and consumed creates a structural imbalance that slowly forces repricing. You don't see it day to day, but you feel it once price starts moving with persistence. From a technical market perspective, silver has been carving out higher quality price behavior. Even when momentum appears muted, volatility compresses, ranges narrow, and reactions from support become more controlled. That's participation changing hands from impatient traders to longer-term positioning. When this happens, downside moves lose energy and upside attempts become more efficient. Markets telegraph their intentions through behavior, not headlines. Silver's behavior suggests preparation, not exhaustion. Another layer comes from intermarket relationships. When you watch currencies, interest rates, equities, and commodities together, silver often acts as a bridge asset. It responds to monetary stress like gold, but it also responds to economic expansion like copper. That dual response makes it sensitive to rotation. When capital shifts out of overextended assets, it doesn't just vanish. It seeks undervalued areas with liquidity and leverage. Silver provides both. It's deep enough for institutions, but volatile enough to deliver meaningful percentage movement when flows arrive. Historically, large silver advances don't start when everything looks perfect. They start when uncertainty increases. But confidence hasn't collapsed. That's the zone where risk is being repriced rather than removed. Investors start diversifying instead of panicking. Silver thrives in that environment because it offers optionality. It's not purely defensive, and it's not purely speculative. It sits between those two worlds, allowing capital to participate in protection and opportunity at the same time. Psychology plays a major role here. Most investors are trained to chase confirmation. They want price moving before they act. But by the time price is moving, opportunity is already being consumed. The early phase of every major silver cycle is quiet accumulation while sentiment remains flat. That's where silver is now. It's not exciting, and that's precisely why it's powerful. Boring markets become explosive markets once structure is complete. When macro forces align, currency pressure, industrial expansion, and capital rotation, price doesn't ask permission to move. It transitions from range to trend, and trends in silver tend to travel faster than most expect because positioning is usually light going into the move. There's very little resistance once momentum builds, because there aren't many sellers left at higher levels. Everyone who wanted out already sold during the boring phase. This is why watching silver today is less about prediction and more about preparation. You're not guessing direction. You're observing alignment. Technical structure is stabilizing. Macro pressure is increasing. Industrial demand is expanding. Capital rotation is inevitable in cyclical markets. When those layers overlap, price expansion becomes probable, not hopeful. Markets don't announce major moves in advance. They build them silently. Silver is doing that now. It's absorbing time, capital, and attention quietly while other assets steal the spotlight. But when alignment reaches its tipping point, silver won't follow the market. It will lead a new chapter of price discovery. Opportunity in markets rarely shows up with noise. Most of the time it appears as patience, frustration, and sideways movement that test conviction. Silver has been doing exactly that while many participants lose interest because price is not delivering fast gratification. The structure underneath continues to mature. Markets that go nowhere for long periods are not broken. They are building balance. And once balance is complete, price seeks a new direction with purpose. One of the most important things to understand about silver is its role in cycles. Commodities don't move the way stocks do. They move in waves of accumulation, expansion, distribution, and contraction. Silver has already experienced contraction in sentiment, not in value. That's a key distinction. Price has not collapsed structurally, but expectations have. Investors are no longer emotional about it. They are indifferent, and indifference is usually the psychological base of a new trend. When you examine price behavior, you start to notice how downside moves are becoming less impulsive. Sharp sell-offs are replaced by controlled pullbacks. Recovery phases take less time. Support zones are respected more frequently. These are technical fingerprints of accumulation. Big capital doesn't chase strength, it absorbs weakness. That absorption creates stability, and stability creates leverage for the next expansion phase. Silver also benefits from something many investors ignore: duration. Time in a range is powerful. The longer price holds a zone without breaking down, the more meaningful that zone becomes. Each month spent consolidating increases the probability that the next directional move is not temporary. Temporary moves fail quickly. Structural moves persist. Silver's current behavior suggests structural preparation rather than speculative noise. Another dimension comes from risk positioning across global markets. Equity valuations, bond volatility, currency pressure, and geopolitical uncertainty all influence where capital chooses to rest. Silver is one of the few assets that sits outside the direct influence of corporate balance sheets and political earnings cycles. It represents neutrality. When investors seek assets that are not dependent on management decisions or fiscal projections, metals gain relevance. Silver's liquidity and volatility make it especially attractive when capital wants flexibility. At the same time, industrial consumption quietly tightens the market. Unlike gold, much of silver gets used and not fully recovered. It's dispersed into products, technologies, and infrastructure. That means a portion of supply is effectively removed from circulation each year. Over time, that reduces elasticity. When investment demand rises, even slightly, price responds disproportionately because available inventory is thinner than it appears on paper. What separates silver from many other commodities is that it doesn't need extreme conditions to perform. It performs in moderate stress, moderate growth, and moderate inflation environments. It's adaptive. That adaptability is what makes it hit dangerous to underestimate. While other assets require perfect scenarios, silver benefits from multiple imperfect ones happening at the same time. From a behavioral standpoint, most investors will miss the early part of the move. They'll be waiting for a confirmation, news, excitement, and public participation. But public participation is always a late-stage feature. By the time headlines appear, structure has already delivered a large portion of the opportunity. Smart positioning happens when the story is boring and the charts look uninteresting to casual observers. Another key element is leverage and perception. Silver is a lower-priced asset relative to many markets, which psychologically amplifies movement. A small dollar move translates into a large percentage change that attracts momentum. Once price starts to trend, it becomes self-reinforcing. Early movement pulls in technical traders, which pulls in funds, which pulls in retail attention. That chain reaction only needs a catalyst. Structure provides that catalyst. The real mistake investors make with silver is thinking in days and weeks instead of quarters and years. Silver doesn't reward impatience, but it punishes neglect. When it moves, it often does so faster than people can reposition. That's why preparation matters more than prediction. You don't wait for the wave to be obvious. You position snorts before the tide changes. Silver's current environment is about readiness, not hype. Price is coiling. Sentiment is neutral. Supply is tight, demand is persistent, macro uncertainty is growing. Those elements rarely line up cleanly, but when they do, markets don't drift. They transition. This isn't about excitement. It's about recognizing when structure, psychology, and macro behavior quietly converge. Silver isn't screaming for attention right now. It's whispering to disciplined investors who understand how cycles actually begin. Silver has a way of humbling people because it refuses to move on anyone's schedule. It drifts, consolidates, and frustrates until most participants stop paying attention. But that behavior is not random. It's part of how capital transitions from speculation into structure. Markets don't explode higher from excitement. They explode from preparation. Silver has been spending time preparing while attention stays fixed on louder, faster-moving assets. What's important right now is not where silver has been, but how it has been behaving. Price action tells the story before headlines ever do. Over time, silver has stopped reacting emotionally to negative pressure. Sell-off lacked follow-through, breakdowns fell faster, recovery stabilized sooner. These are not signs of weakness. They are signs of absorption. When supply keeps hitting the market and price refuses to collapse, it means stronger hands are taking control beneath the surface. One of the most underestimated elements in silver is positioning. Large capital doesn't rush in all at once. It layers, it builds exposure while volatility is low and sentiment is quiet. Process looks boring from the outside, but it's exactly how major trends start. When the foundation is complete, price doesn't creep higher. it accelerates because participation suddenly shifts from accumulation to expansion. Silver also sits at an interesting crossroads between investment demand and real-world necessity. It isn't just held, it's used. Every solar panel, circuit board, medical device, and electric vehicle consumes a little more of it. That consumption isn't theoretical. It removes metal from circulation. Over time, that reduces available inventory even if production numbers look stable. Investors often focus only on mine supply, but the real issue is usable supply. As technology expands, silver's role expands with it, tightening the market quietly year after year. This another layer comes from how silver reacts to currency behavior. When purchasing power erodes, people instinctively look for assets that are not tied to promises. Silver has thousands of years of monetary relevance behind it. Even in modern markets, that psychology still exists. It doesn't show up immediately in price, but it shows up in capital flow, slowly at first. Then suddenly, once confidence in paper systems begins to wobble. From a technical perspective, a silver benefits from long basing periods. The longer price holds a range without breaking lower. The more energy is stored in the structure. Each failed breakdown reinforces support. Each recovery reinforces participation. Over, that creates a launch pad when resistance finally gives way. It's not just a breakout, it's a repricing process driven by months or years of compression being released at once. What makes silver especially powerful is its ability to move faster than expectations once momentum arrives, because it's often ignored during its base building phase. Positioning tends to be light. That means when buyers show up in size, there aren't many sellers above prices to slow the move. Liquidity thin, spreads widen, and price travels quickly. This is why silver moves often feel shocking to those who weren't prepared. They assume something changed overnight, when in reality everything changed slowly beforehand. There's also a psychological trap with silver. Many investors associated with disappointment because they remember past rallies that failed, but markets evolve, structure changes, participation changes. The mistake is anchoring to old behavior instead of reading current behavior. Silver today is not the same silver from previous cycles. Industrial relevance is higher, monetary pressure is higher, global uncertainty is higher, and technical preparation is more mature. Markets reward alignment, not prediction. You don't need to know the exact catalyst. You need to recognize when enough forces are pointing in the same direction to create probability. With silver, those forces are stacking quietly. Controlled price behavior, tightening usable supply, expanding industrial demand, and growing macro uncertainty. None of those alone guarantees anything. Together, they create opportunity. The smartest investors don't wait for permission. They observe structure, sentiment, and flow. When an asset stops breaking down and starts holding value despite pressure, it's sending a message. Silver has been sending that message patiently. It's not asking for attention, it's building relevance. This phase is not about excitement. It's about readiness. By the time silver becomes exciting, the easy and dear, the positioning advantage is gone. The real opportunity exists when price feels slow, narratives feel quiet, and conviction feels uncomfortable. That's where structural trends are born. Silver is not trying to impress anyone right now. Doing something far more important, he's preparing. And in markets, preparation always comes before performance. So, let me leave you with this. History rewards the few who act when others doubt. Legends are made when opportunity aligns with courage. If you wait for silver to confirm its breakout, you won't be late, you'll be too late. But if you position yourself today while fundamentals are still forming, you have the chance to ride a move that many will only talk about after it has already happened. The question isn't if silver will make a new historical run. The question is, will you be ready when it does? Gear up, position yourself, think big, because this, my friends, could be the next great chapter in hard asset investing. If you want, I can also provide a shorter version for YouTube narration, a script with vocal emphasis cues, just a bunch of tone, mill, and title suggestion. Just tell me no one keynote expand in 700 words without heading in a crisper mood, tone, and style. But don't mention silver has spent years sitting in the shadow of other assets, quietly building pressure while most investors chase whatever is loud and fashionable. When you look beneath the surface, what you see is not weakness, but compression. Markets move in cycles, and before every major expansion phase, price action tightens, volatility contracts, and sentiment fades. That's exactly where silver has been living. While headlines move from stocks to crypto to real estate and back again, silver has remained structurally undervalued relative to its historical behavior, its monetary role, and its industrial importance. This is the type of environment where informed investors start paying attention long before the crowd realizes something meaningful is happening. If you study long-term charts, silver has a habit of lagging first and leading later. It rarely explodes out of nowhere. Instead, it grinds sideways, frustrates participants, shakes out weak hands, and when positioning becomes light and expectations drop, the real move begins. From a technical perspective, silver's multi-year structure has been one of accumulation, not distribution. Price has repeatedly respected major support zones. Momentum has refused to collapse, and each sell-off has been met with quieter, less aggressive downside pressure. That tells you something important. Sellers are running out of fuel while buyers are becoming more patient and strategic. At the same time, silver is not just a shiny metal sitting in vault. It's an industrial necessity. It's embedded in electronics, solar panels, medical equipment, electric vehicle, data centers, and modern infrastructure. As global technology expands, silver demand expands with it. Unlike paper assets, silver can't be created with a keystroke. It has to be mined, refined, transported, and processed. That takes time, capital, and stable political environments, all things becoming less predictable around the world. When demand rises faster than supply can respond, price doesn't drift higher, it revalues higher. What makes silver especially interesting is its dual personality. It behaves as both a monetary metal and an industrial commodity. When inflation expectations rise, silver attracts capital and courage. When economic activity expands, silver gets consumed. When currencies weaken, silver gains relevance as a store of value. That combination creates powerful asymmetry. Few assets benefit from multiple macro forces at once, but silver does. It doesn't need just one narrative to work. It has several, all pointing in the same general direction over time. Another important factor is relative valuation. Historically, silver tends to outperform gold during strong precious metal cycles. Yet, for long stretches, silver underperforms first. That underperformance builds leverage into the system. When capital finally rotates, silver doesn't move politely, it accelerates. You often see percentage moves that surprise even experienced investors. This is why seasoned traders watch silver quietly while others ignore it. They're not waiting for excitement, they're waiting for alignment, price structure, momentum behavior, volume characteristics, and macro stress to start pointing the same way. From a market psychology standpoint, silver is currently disliked enough to be interesting. There's no wide